Today's number is 1 because Elon Musk just got approved a $1 trillion potential pay package should the stock do the right thing in the future. We need to discuss that, but also some other huge things. With the NASDAQ and S&P 500 both going through key supports, it opens up some of the major levels we've seen in the past. And remember, we've already had a Wall Street phantom print at the 600 level for the Qs. So in today's video, we take a look at whether we're going to get mean reversion, what's going on with Bitcoin, and where we now know huge liquidity is. Yes, guys, we could be looking at one of the biggest hunts ever in history, and today we need to talk about it. Stocks, commodities, and cryptos, a lot coming up, and some incredibly important points. Don't go anywhere. We'll see you in a moment. Well, welcome back everyone to The Daily Show. My name's Thomas Atkinson, and in today's video, we've got the latest macro data and of course, what Wall Street doesn't want you to know about the markets right now. It was big tech down, driven by tech post AMD earnings, continuing to see a flush, but maybe more importantly than any of this, traps have now been set. Certain key levels in today's video that we'll be unveiling may be the key pointer here to what actually does end up happening next, where the markets continue to go down on concerns over all sorts of things, including jobs numbers, and whether we start to see the largest liquidations in history. So first up, let's talk crypto for a moment here and have a look at this liquidation map. This is courtesy of Jay Brusquito over on X, and he's been posting me a couple of these things, and I tend to agree with him with an important level. So let's take a look here at the liquidation map. Straight under around that $93,000 on Bitcoin, it looks like a lot of people have stop losses. So if we do drop that 98K that we've been discussing, that seems like the obvious level for the markets to then drop into. What happens here though is going to be super important, as we do know that we are at the end of what you would traditionally see as a Bitcoin halving cycle. In the last week, we ended up getting a little bit of whale accumulation, which is a good sign. But as you can see here, it's still been an overall distribution. That is that whales have generally been selling at an average certain amount of coins per day over all of this chop that we've now had for the last couple of months. And this looks familiar to what we had in 2024 into 25 before the sell-off. And of course, something very familiar to what we had during that 2024 period as well. The question will then be, will it rally after it drops? And why is this one smaller than all of the previous major ones that sent us down? So distribution will be key. And of course, we're looking at what the whales are going to do next, especially around the 98K level and around that 93 to 94K zone. Do remember that when we have RSI as oversold as it's been, fear and greed index hitting levels like it is right now, traditionally, Bitcoin has actually been rising over the last couple of years. But of course, these are different periods in the halving cycle than at the end. So let's actually now have a look at where we are in comparison to those previous points. And this is from Brett_eth over on X. And you guys can see here that we have quite a lot of overall synergies. Now, we've brought this up for weeks and been talking about it. But what this really is just showing you is that every other cycle, probably the most studied cycle in history, have actually had a very similar point of end, around that 550 days from the halving to the top to the top being around that 1450-ish kind of average, and bottom to top obviously being around 1060. And guess where we find ourselves at this point in the video? Yes, we're in that 1060 range. So of course, it's now or never when it comes to crypto and whether it's going to hold the cycle or that is crash potentially here, or whether it's going to continue and now break it. Now, of course, Wall Street has entered the chat, guys. It's entered the DMs. So when Wall Street enters, usually well-known things tend to break. Why? Well, Wall Street likes to liquidate and likes to play funny buggers with all of us. And that is why we're paying attention more to the price action this time than just the general correlation. Last time, back when we've been running this channel now for over 5-6 years, you guys know that we were all about the halving cycle. This time around, though, I'm a little more unsure. So some of you have said, no, it's still going. Some of you said, no, it's going to break. And I think it really is going to be determined by the next pretty much 50 to 100 days. We're going to know most of the things we need to know, and price action will obviously be key in between them. So why are we worried about a halving cycle? Well, a halving cycle, if it comes to an end, often brings with it an 80% decline market. Now, in between then, you can have a lot of 20, 30% declines and it be perfectly normal. So when we have a look at Bitcoin later along with Ethereum, we'll bring together some correlation zones that I think you guys will find interesting. And remember, this will probably come back to the options market ultimately now that Wall Street is in this market. It's all going to be about where is the maximum profit to be made. So let's take a look now at Fundstrat, macro research here, courtesy of Mike Zaccardi. Obviously, Tom Lee's company believes that we're going to see a choppy 2 weeks. Now, this is a little bit different to, of course, what I heard on the news, but anyway, it doesn't really matter. The main thing is this lines up pretty well with some of the data stats that we've been sharing recently. So let's look at the good, the bad, and maybe even a little bit the ugly of what's coming forward and why we still maintain that most likely dips are going to be purchased. First up, concerns over growth, concerns over the economy in general. Remember last week, we moved down to the 60s or even 50s in percentage chance of getting a December rate cut. Well, this is now back all the way to 70% once again. And you can actually see here why that might be happening. Remember, the Fed's job is technically what we call a dual mandate. On one side, they're meant to be balancing inflation and those concerns. And on the other side, they're meant to be balancing, of course, the employment factors. Well, employment seems to be getting worse and worse and worse. The monthly change in non-farm employment is expected to go negative, which is, of course, not a good read. And it's going to be super distorted due to the government shutdowns. So if we do get all this data over the next 24 hours, we will, of course, be reporting on the weekend. But more importantly, it's going to be really distorted and really hard to cut through. So you may see a shocking number when you first see that number. It could be absolutely wild. But just remember, it's more about what is Wall Street doing rather than what the news and the press is saying. It's a very big delineation here. That's why we say if it's in the press, it's in the price, guys. Remember, do not feel fear on those massive, bold statements. Let's now have a look at the problem with the market right now. The big one is, of course, that we are now too heavy in tech. Now, whenever you get concentration like this, over 40% of the entire S&P is now made up of just technology stocks, then you're starting to get into what is known as a concentrated or bubbling market. Now, does that mean it's ended? No, and that's key. But it is a concern over the index for the future. It often does mean that we could go into what's called the lost decade. And we've talked about this before, but of course, it's something you've got to keep in the back of your mind just in case and remember what's going on there. The other issue is, of course, we just entered 7 months up for the NASDAQ. Now, that's a historically great run, and it does tend to bring with it further bullishness. But the problem is, when we get a read like this, we often do have chop or downside. So you can see this is the month of course, October finished. We are now in the first week of November, and no surprises to anyone, we're starting to see weakness. Now, why is that? Well, actually 0% of the time, that's right, 0% of the time during similar reads have we been bullish 2 weeks later. And I do tend to like these stats because, of course, these ones are the reads that we've used similarly to actually gold being up, 9 weeks straight, and then the next week was never bullish, and guess what? Boom, we ended up busting off. So look, could we go down? Absolutely. How far? Well, you can see here the average is about 5%, so not that bad. And while that may smash around a couple of stocks, it's not that bad. Now, where it gets a little ugly is some of the information that's been coming out here recently. Now, Sentiment Trader obviously shared this info, and I never heard of this one myself, but something called the Titanic. Yeah, so we're going to make a movie about this, guys. The Titanic cell signal cluster and the Hindenburg. Can you imagine that? That is a wild, that's a wild film that could be written. But we've got both triggering at the same time. And a few boffins went through, including Neil here, Neil Sethi, I think, over on X, and actually figured out that when you're looking at these stats and you look at them both together, the Titanic and the Hindenburg, you start to get nastier stats for the next 1 year in future. Because remember, the Hindenburg is not that conclusive by itself. Blue Kurtic also went through and found, well, wait a second, what if we attach this with Fed rate cuts? That is, rate cuts near all-time highs, Hindenburg omen signals, and potentially also some Titanics. Well, it turns out that when we've had a Fed cut within 2% of the S&P 500 all-time highs, and it's occurred within 2 months of a Hindenburg omen anyway, that is not that good when it comes to max drawdowns. So there's actually quite a lot of large drawdowns. So buckle up for 2026 because this could mean that we are going to have one of those double-digit drawdowns again. And I actually do expect 2026 to be incredibly volatile based on midterm cycle and all the sorts of things, including at the end of the year, of course, the midterm elections, which in the US obviously will be big this time round. At least that's what we're probably expecting. Let's have a look here at the S&P 500 when Hindenburg omen triggers. You can see here again, it's not that conclusive, but more negativity coming into the markets. I think the important thing here is this is the first level of negativity that we've really seen on these types of reads through this entire Liberation Day rally. So what it's telling us is we're now starting to see a cluster of weakness in breadth, a cluster of weakness in the markets. But at the same time, is the market still bullish? These are early indicators. Often they'll give you a couple of weeks of a little bit of weakness. They'll then go back on. Everyone will forget about them. And it's really actually coming back to them and revisiting them in 3 months that you've got to do. Now let's have a look here at the S&P 500. This is a good one here from Don's Dividends, like this chart, which obviously is the energy versus S&P 500 sector. Now we've been recently talking about oil services, which have been improving for the last couple of weeks. And that's been pretty sweet. But at the same time, again, usually what you've seen is during these bigger dip areas, as we start to see weakness, a pit, or even a small pullback, we've actually started to see energy pick up in the past. Now, that's only happened for a couple of years, but it is a very interesting observation. I certainly think we need to be paying attention. It's also worth noting that in the global markets, we're continuing to see markets doing pretty well, whether it's, of course, the Korean market, the Nikkei, the Euro stocks, the UK 100, and the FTSE, that is, any of these markets, they all tend to be running hot. And particularly the Asian markets are running parabolic. Now, that's scary in itself when anything goes parabolic, but we still need to be paying attention to all of this and noticing that it's still strength to strength to strength at this stage. We know why as well, because people are chasing. People are using leverage. Have a look here at margin debt rate of change. This one's over on our chart over on X. If you're interested, follow in the links in the description down below. And it just shows that people are levering really hard right now. And obviously when people do something, look, you're better off following the trend. You're better off not being contrarian for contrarian's sake. But at the same time, you need to be aware of the risks. You're aware, but not necessarily terrified. And that's why we bring them here to the channel, because we know the trend is still up at this stage, but we're recognizing that it's weaker than it was, let's say, 3 months ago. Let's have a look here at UPRO. A couple of large dark pool trades came in over the last 24 hours. Have a look at these ones. Big positions. 4th, 5th largest. Last time we saw a big one, we ended up getting a massive rally. So this does tend to, of course, matter. But we've also had semiconductors. We've had VOO also get a massive trade. So it suggests that someone's taking a little bit of profit off the table. Maybe they'll re-enter soon. Who knows? Maybe we'll get a 5% pullback and finally hit that mean reversion. Tesla also getting a couple of trades. From this point, we've obviously been up, then down, then kind of floating. $1 trillion pay package. Wow, that's going to be massive. I mean, the first trillionaire, what do you guys think about that? That's going to be ridiculous. I don't know why you need so much money, but anyway, $1 trillion. And the thing about all of this is, of course, what it's doing is it's setting up Tesla for potentially a massive hype fest. So I think the hype train and therefore the options gamma next year could make Tesla a very good trade because it's going to get wild what's going to be said, I think. Let's take a look here at the Qs. You can see clearly the phantom print that we mentioned this week. And what it did was it gave us a hint that if the markets continue to fall, which they have so far, that we may be targeting, at least AI is targeting, 600 on the Qs, which just so happens to match pretty much around the weekly 20 moving average on the S&P. And you guys know why we like correlation across the board. So much chat has been had of whether the US market is weakening enough to allow or make the Fed do QE. Well, just you wait, because of course the PBOC, well, they've come out and they've started QE again. So clearly central banks around the world are starting to realize markets are weakening. They're coming in to support them. And this is again a sign of generally a later cycle bull market. So this is where you start to say, okay, well, wait a second. Are we going to see consumer staples hold? Are we going to see XLV hold? XLU continue to do well? And of course, are we also going to see the rise again of energy stocks? Now, that is all interesting, but one thing's for sure is although there are cracks in the financial system, particularly in the small regional banks, which is where the problem's going to lie initially, the big six banks, look at this chart here from Steven Strasser, it's continuing to spike up. So clear as day here, you can kind of see there's a difference in the market between quality and crap. The other thing is I don't usually expect a market to actually have topped off while earnings continues to rise, particularly earnings in the top stocks. If we have 40% plus concentration in the market in tech, and we have tech absolutely blitzing earnings, markets have never actually topped off at that point. Usually what happens, you'll still get normal volatility over whatever concerns they want to write in the media, but at the same time, generally markets will go more bullish. And that's just a data stat that, of course, we've run with over time. As we mentioned, though, markets are, of course, quite overbought at this point. 7 months up in a row is extreme. So the last stat we want to mention here before we go into the options and the next levels is, of course, November, December generally is positive. And even if we get pullbacks, which aren't unheard of, take a look at here at the max pullbacks, an average of 4% almost. That's going to come important when we have a look at the Qs in particular. Well, you can see here that 95% of the time, the markets are bullish by the end of the year, and only one time were they negative. And I think that's still negligible in this grand scheme of things. And that's because it seems like we're tracking this kind of market right now, the 98 to 99 narrative, which means that 2026 is going to be nuts. Let's now take a look at earnings. You guys can see here that we have plenty of different earnings still coming out on Friday. We've got Wendy's, we've got plenty of other companies here. And of course, we continue this into next week. So we'll be tracking that as we want to go through it. Now, we did end up getting another Hindenburg omen. So we've got 4 cluster now, which is pretty wild, though there are ways of calculating this a little bit differently. I think still keeps us at 3. But more importantly, on the S&P, let's have a look here at this key point, which is, of course, that we broke underneath the anchored VWAP off the low, the daily 20, and we exposed now the weekly 20 in particular. And what this does is generally it would mean that we are finally going to get that mean reversion that markets always go towards. And it does seem more likely than not that's kind of the way we're looking. Now, that would be a 6% pullback. And that is, of course, I think a very interesting level. And we'll look at that in the options in a moment. But take a look here at the Qs. So we'll load the Qs up. This would be a weekly 20 would be 582. Obviously, a 600 is where we saw that phantom print, which would also mark out around a 6% down. So certainly well within the normal parameters of the bull market, well within a normal kind of pullback. Usually we see them August, September, or October. Well, this year, a little bit later. Maybe we're going to get in November here. Let's now take a look at the US 500. You can see here the options high and lows, guys. And we, of course, took the low, which I think this is very clearly a series of lower lows and lower highs at this point. So the market is obviously, trying to get a little lower after what has been a pretty big run. And one of the things here is, of course, some people may have purchased in here with stop loss below. Well, that has now been hunted. So very important zones. Let's have a look here at the S&P. What have we got? We've got a 6,700 put wall. So that's going to be tough for it to get through it. Obviously, if we do get the jobs numbers, then they go bad and the market chooses to sell off based on them. Remember, those jobs numbers alone are not going to take the market down properly. It will be expected that the Federal Reserve will come in at some point and support that number with more cuts. So just remember that although the market might freak out, the press might freak out, that's not usually the catalyst that stops you buying a dip. There are other bigger problems, more sinister problems that are in our economies at this point. I'm sure you guys are aware. So 66.50, also an interesting zone. And as we expect, when we get down to these levels, we'll start clearly defining put walls at different areas. So, of course, wait until Friday's close and we'll have an update on that one on the weekend to really have a look at these key levels. Let's take a look at the Qs. I thought I'd add the Qs in here just to show you that when you're taking a look at November, especially the OPEX, you might notice 600 comes up a lot. So we do have quite a lot of puts sitting right on that 600 level, and it's of the bigger sizes. Also 610 as well, getting some large sizes on it as well. So clearly there's a bit of action here to support the markets should we come down a bit more. Tesla, 445 after the $1 trillion of pay package was approved. And of course, 500 technically still overall in positive gamma. We're getting to the neutral point now, but the market is still slightly bullish on Tesla. So hopefully it can hold up, and has been holding better than the other stocks at this point that are in that big kind of top 10. You can see Nvidia's come back down. That's sitting in the 188s. It's certainly struggling, but a lot of puts are starting to surround it. And you can see here for IBIT, 56 is going to be a big, 56, 57 is going to be a big break level. And if we get underneath that, it could create a big sell, negative gamma waterfall moment. And then all of a sudden we could be at 93, 94K for Bitcoin. And that, I think, is where the real decision is going to be made. A lot of liquidations underneath 93 should it happen. Anywhere around here, though, is a pretty exciting level for Bitcoin holders because it is a very key level. And this next 4 to 5, I think I said 4 to 6,000 in some of the replies yesterday in the comments. This level is the most interesting. There's no doubt about it. You've got to be paying a lot of attention to it. And it's clearly a decision point here for whether we break a cycle or continue with it. Let's take a look at GLD. You can see here that we've got a 360 kind of read and a 365. So two kind of key points here, and we are sitting on one of them. I think the 360 is a very interesting read because that is starting to line up very well with that 3850. So we'll continue to watch that as close as we can. Let's go over to the reads of the market. First up, lead indicators. Nothing going on with bond spreads. No break to the high. If that happens, then of course, even more solidification, or at least solidifies the idea that we're probably going down to those weekly 20s and the Qs to 600. And you can see here, Latin America, Euro stocks, they're still quite bullish markets. So again, you've got to pay attention to all the markets in the world because we are a global economy still, even though that's decoupling. And the one I'm actually watching the most is this DAX, because the DAX once gave us, if you remember back a few years, the DAX gave us an amazing read on significant weakness. So this could be a Wyckoff distribution. I'm paying a lot of attention to the DAX, and you can see it's about to drop the weekly 20. But if it drops this alert I've got down here, things could get nasty quickly. So very closely watching this one. You may want to do so as well. Nvidia rallied up, hit fair value in terms of forward PEs, come back down, still technically in an upward trend. We'll look at semiconductors in a moment. And dollar index is having a breather in what has been a pretty nice move against, again, most people's sentiment. So I'm still looking at the 101, 5, 50, 60 zone and just looking for further additional confirmation there. Gold chopping up, nothing much to talk about in gold, just kind of sitting. And silver also just sitting between that 49.50 and the current level. So not really any changes here, guys, to gold, silver. We've suspected that's what would happen. Semiconductors did complete 80% of their flag length. So this is usually where we see semiconductors take a breather. No surprises there. This is semis versus SPY. I think, again, it's not really showing significant weakness in semis, but it is certainly, kind of having a sleep at this point. And then we've got Tesla with the massive approval dropped, rallied by the end of the day and held the zone. I think it was up a little bit in after hours. So be interesting to see what happens here. Weekly close is still pretty solid for Tesla. And I still think that in next year's reads, we're going to have a lot of Tesla news coming out. Elon's going to be working for that trill. He's going to be posting, and it'll be a PR, a massive PR thing. 610, you can see here we have a key level. 600 is daily 50, which just so happens to be phantom print level. So why is this important? Well, it's where we've already seen something be programmed, it looks like. So I think I'm paying most attention here. I feel like the market can get here now that we closed underneath the low. But again, we always remain adaptable should the market, push to the upside or something like that. Let's now have a look at crypto. One of my more interesting areas at the moment, I feel like, for all of us is the crypto markets, just because there's a huge decision to be made. We are sitting within Ethereum towards the daily 200 and the anchored VWAP. So it's kind of like that compression solid area for it. But I think Bitcoin's probably the most interesting. The Scottie Pippen level, the weekly 50, but I like the bit of demand that's underneath it. And this is where I think the real decision is made. I think a lot of people will be missing this one, guys. We know there's tons of people with stops just under here. So what if we go blah, what? If we do something like this, or we come down and we do this, and then we smash up and we go past 104, I think I'll actually be quite bullish for it. Do remember, this is technically a Wyckoff that's about to activate as well. So decisions will have to be made here quickly by the street to reverse if it is going to be a trap. What a big time it is here for markets, though, and I think you've got to be paying attention. Remember, jobs numbers may be shocking. They may be even all over the press on the weekend, and people will be running around like headless chickens, especially if the markets continue to fall. But the key is to actually break down, have we had good earnings? The answer is quite simply yes. And traditionally, when the big earnings from the biggest companies have held true, the markets may dribble down and go worse for a little bit, but they do tend to buy back up. It's really the concerns over the regional banks and the debt crisis that I think is looming in this economy that I'm more concerned about. And that's why we'll be tracking that together as much as we can. If the bonds don't freak out, I guess none of us really should be. Thanks so much, guys. If you enjoyed today's video, please remember to follow us. Make sure to sign up for the free weekly newsletter. We've got a new one coming soon. And then, of course, check us out next. Check me out on LinkedIn. And if you're interested more in our courses, you can follow our 7-day course flash sale that's on right now. Thank you so much. I'll catch you in the next one. Bye for now.